All right, guys, let's start. Okay, now we are doing your lesson number two. Lesson number two of chapter number one. Chapter number one is your introduction to yield curves. We are doing yield curve modeling. And then in chapter number one, lesson number two, we are looking at zero coupon yields. We are looking at spot rates. We are looking at forward rates, right? So that's the whole sole objective of this particular lesson, right? So let's get started, guys. Okay. All right. So see, in the previous lecture, right, in lesson number one. In lesson number one, we kind of uh, focused on your what you say, the term structure of interest rates, right? Now we are getting into your coupon yields, spot rates, and forward rates, right? So please understand that. And once you've understood that, I think things will fall into place. Okay, so let's start. Let's get started, guys. Now, when you talk about your uh, zero coupon yields, right? Zero rates, right? First of all, what is happening in this lecture, right? So the lesson is covering your three objects: zero coupon yields, spot rates, and your forward rates. All three are rates made of a single curve. So the rest of the presentation kind of builds on that, right? So we talk about the zero coupon yields, understanding zero coupon interest rate. Zero coupon yield, zero rate is the interest rate earned on a bond that makes a single payment at maturity. Unlike a standard coupon bond, there are no intermediate interest payments. Key characteristic: investors receive only the face value at maturity, no periodic coupon payment, provide a pure measure of the time value of money. Importance in finance: each maturity has its own zero rate. These rates collectively form the term structure of interest rate. They're the foundation of constructing the yield curve. Zero coupon yields are widely used in the valuation of bonds, swaps, or interest rate derivatives, right? So, uh, new terms which are coming here. One is the zero coupon bond, a bond that pays one cash flow at maturity and nothing before. Zero coupon yield, also zero rate, the annual return earned on that single payment. Face value, the fixed amount paid at maturity. Coupon is the periodic interest payment. Zero coupon bond has none. Term structure of interest rate, the full set of zero rates across all maturity. Yield curve is the graph of those rates against maturity. Because there is only one cash flow, the rate is not blurred by reinvestment of coupons. Once maturity gives you one clean rate, right? So uh, stack those rates across maturity in the term structure, kind of a BS. Where it is used, zero rates are the discount rates used to price bonds, swaps, and interest rate derivatives. Every discounted cash flow model in the fixed income starts here. Okay. And the next one is the zero coupon yield calculation, mathematical representation of zero rates. Consider zero coupon bond that pays $1 and maturity T. That PT denotes the current market price of this bond. Annual compounding is this. The slide basically converts between the price of a zero coupon bond at zero rate into compounding conventions. T is basically maturity measured in years. PT is today's price of a bond paying $1 at time T, also called the discount factor of maturity T. R sub T is the zero rate from maturity T. Exponential is the constant 2.71828, the pace of natural growth. Ln is basically the natural logarithm of the inverse of exponential x. Annual compounding, when we're talking about P of t equals 1 divided by open bracket plus R sub t, close bracket raised to power t. The price today is $1 pulled back t years at the rate R sub capital T. Interest is added once a year, so the growth factor 1 plus RT is applied t times divided by the factor converts the future dollar into a today dollar. And then we had R sub t, right? R sub t equals open bracket 1 divided by P of t close bracket raised to the power 1 over t minus 1. This is the same equation rearranged 1 by P t, right? It's the total growth over t years, raising it to the power 1 by t makes the tth root, which turns total growth into growth per year. Subtracting 1 strips out the principal and leaves the rate, right? Then we have continuous compounding, right? Which is given a P of t equals exponential raised to the power minus R sub t times t, where interest is added at every instant instead of once a year. The discount factor becomes an exponential. The minus sign means the value is shrinking and maturity lengthens. R sub t is minus 1 by t yeah, ln, right? Natural log of et. R sub t equals minus 1 over t times the natural log of p of t. This inverts the previous line. The log undoes the exponential returns minus rt into t divided by t, flipping the sign t is the rate per year. Two conventions that are easy to confuse here: annual compounding discount factor 1 by 1 plus R sub capital T raised by T. Continuous compounding discount factor exponential minus R sub T into T. Rate applied, annual compounding rate applied once per year, continuous compounding rate applied at every instant. The one difference that matters here is that for the same price, right, PT, the continuous compounding rate is always a smaller number. The two rates are not interchangeable inputs. Rate is used. This is the bootstrapping output. Discount factor comes from market prices. Zero rate comes from discount factor. Every swap and bond valuation uses them. So zero rate across different maturities from the zero coupon yield curve, which is widely used in the valuation of swaps, forward rate agreements, interest rate derivatives, and fixed income securities. So that is very, very important. Okay. Then we get into next part, which is spot rate. Definition and characteristics of spot rate. The spot rate is the interest rate applicable today for investment that varies immediately and matures at time t. In fixed income market, the spot rate is essentially equivalent to the zero coupon yield. Spot rate represents the pure discount rate for a single cash flow offering a specific maturity. Spot rate may be expressed in several forms: annualized zero rates, quarterly compound rates, simple rates commonly used in short-term money market. Each spot rate corresponds to specific maturity T and used to discount future cash flow, which is given by this equation. The PT is the present value of payment at time T and R for capital T is the spot rate. Spot rates are typically obtained through bootstrapping from market instruments such as treasury bill, deposit, futures, swaps, and coupon-bearing bonds. So the idea which is coming out here is the slide defines the spot rate and states that it is the same object as the zero rate, right? And what is spot rate? Spot rate is the rate agreed today for money invested today and repaid at time T. Pure discount rate is the rate that applies to one cash flow only with no coupon mixed in. Simple rate is the rate with no compounding at all, used for short money market periods. Bootstrapping is the step-by-step procedure that extracts the rate from rate instrument short of maturity first. The slide lists kind of three ways to quote the same rate: annualized, quarterly compounded, or simple. The underlying prices are identical, right? Only the quoting convention change. P of t equals exponential raised to the power minus R sub t times t, right? This repeats the continuous discount factor from the previous slide. P sub t is the present value of $1 paid at time t. R sub capital T is the spot rate for that maturity. The last line names the instrument used in bootstrapping: treasury bills, deposit, futures, swaps, and coupon bond. Short maturities come from deposit and futures. Long maturity comes from swaps and bonds. Where it is used, the spot curve is the discount curve for every present value calculation of the risk book. Okay. Then we go to the next part, which is line number 5, spot rate example in your fixed income market, real world discounting using spot rate. Consider an investor who will receive $100 in 1 year. Assume a 1 year spot rate is 5% with annual compounding. The present value of the payment is calculated at this. This means that receiving $100 after 1 year is equal to receiving approximately 95.2 for today. In real financial market, institutions such as banks or hedge funds use spot rates to price your government and corporate bonds, value interest rate derivatives, discount swap cash flow, construct yield curves for risk management. The spot rates play a central role in fixed income valuation and quantitative finance modeling. Okay, so one work discounting example is given here. PV is the present value, obviously the amount today that is worth the same as the future payment. And PV is equal to 95.24. So 95.24 invested in 1 year at 5% grows to $100. The two amounts are the same value at different dates. Where it is used, the single division is the kind of atom of bond pricing, swap valuation curve construction, and bond price is sum of many such terms. Then we get into forward rate concept of forward interest rate. The forward rate is the interest rate agreed upon today for a loan or investment that will be in specific future date in the later date. R1 and R2 are given. The forward rate between T1 and T2 denoted by FT1 T2 represents the interest rate applicable for the period starting at T1 and ending at T2. Forward rates are determined under the principle of no arbitrage. This means that an investor should earn the same return whether they invest directly for the entire period or split the investment into shorter period. Forward rates are fundamental in fixed income markets and widely used in the valuation of forward rate agreements, interest rate swaps, bond pricing, and term structure models, right? So the point here is that the slide basically defines the forward rate and states the principle that fixes level new symbol which comes at T1 start date of the future period, T2 the end date of the future period. T2 should be greater than T1, R1 the spot rate maturity T1, R2 the spot rate maturity T2, FT1 T2 the forward rate covering the period from T1 to T2. No arbitrage means the condition that two strategies with the same risk and the same cash dates must return the same amount or riskless profit will exist. R1 is the spot rate maturity T1, R2 is the spot rate maturity T2. The forward rate is agreed today but applies to a period that has not yet started. It is not a forecast produced by anyone. It is the number that makes the two funding routes to T2 return the same amount. Where it is used, forward rate set the exact rate on forward rate agreement, predict the floating leg of interest rate swaps, and feed the drift into term structure model, right? So that's what we understand. Then we get into slide number 7, which is forward rate with annual compounding, deriving forward rates using no arbitrage. Forward rates are derived by equating the returns from two equivalent investment strategies. Strategy 1, invest $1 today for T2 years as spot rate R2, then we get 1 plus R2 is for T2. Strategy B, invest for 2 years, T1 years as spot rate R1, then invest from T1 to T2 at the forward rate T1, T2. Which is given by this equation, which looks a very tricky equation. I'll explain. Under the no arbitrage condition, both should equate. And solving for the forward rate, we get this equation. This formula allows forward rates to be extracted from observed spot rates. So what is happening here? Basically, slide is driving the forward rate by setting two strategies equal, right? So strategy A, invest $1 today for T2 years at spot rate R2. So 1 plus R sub 2, all raised to the power T sub 2. Then $1 goes with the factor 1 plus R2 once a year for T2 years. Strategy 2, invest for T1 years at R1, then enroll into a forward rate from T1 to T2. So that is given here, right? First, you are investing at invest for T1 years at R1, and then you are rolling forward at into forward rate for T1 to T2, right? The first factor is the growth over the first leg. The second factor is the growth over the second leg, the exponent T2 minus T1, the length of the second leg in years. No arbitrage condition, you equate both first and second equation. Both routes start from $1 today and the date we do. Both carry no risk because the forward rate is locked in today. Equal outcomes are therefore post. And then we get the forward rate calculation from there, right? So the ratio inside the bracket is the growth that must happen between T1 and T2. The outer part takes the root over the length of that period, converting total growth into growth per year. Subtracting one leaves the kind of rate, right? Where it is used, this is the pricing formula for an FRA rate for each forward starting period on a swap. Okay. With that, we move to slide number 8, which is forward curve versus spot curve, forward greater than spots, upward curve. We have rate and we have other things. Basically, bar chart, the horizontal axis holds the unlabeled categories. The 1 year spot rate, 2 year spot rate, the 1 into 2 forward rate. The vertical axis, the rate is the percent. The bars are 3, 4, and 5.01. Right. Okay. So the reason is arithmetic. The 2 year spot rate is 4%, is the average the first year at 3%, second year the forward rate for the average to reach 4%, the second year must exceed 4%. Again, the technical clarification I'll add here is that the chart titles F12 as 5.01, but the bar is labeled 5.01, right? So I think the bar is right, because if you compute, it comes out 5.01 actually. Right, that's a typo which is happening. Then we go to the next part, which is spot rate versus forward rate. Key difference is the feature, the spot rate and the forward rate, a comparison table, followed by the formula from slide number 7, which we have seen, right? What is only the notation is changing, right? Nothing else. The deck switches from R1, R2 to S, T1 and S. T2 and ST means the spot rate and maturity T. It is the same quantity as R sub capital T on slide 3 and R on slide 7, right? 3 symbols, 1 object. The table lines up 6 feature. If you read top to down, spot ST starts today and at T, quoted directly in the market used to discount the cash flow today. Forward rate F, T1, comma T2, right? Starts at T1 and at T2, backed out from spot rate used to fix the future borrowing and lending rate. The one difference that matters is the spot rate is an input observed in the market. The forward is an output implied by 2 of those inputs. Then we have the formula, then we have the calculation, which we have seen earlier. Same rearrangement as before, divide out part of the growth already earned by T1, the annualized what remains, right? So that calculation is same as we saw in the earlier slide, right? This is the same calculation made. The same calculation we saw in slide number 7, which is repeated in slide number 9. Okay, so don't bother too much. Then we have slide number 10, right? Slide number 10 is about forward rates from discount factors, forward rate using discount factors and continuous compounding. Forward rates can also be expressed using discount factor. Let PT denote the price today of zero coupon bond paying so and so. The forward rate between T1 and T2 under annual compounding is given by this. Continuous compounding representation, if rates are continuous compounded, the forward rate simplifies with this and this, or equivalently given by this equation. The continuous formulation is widely used in advanced interest rate models such as the Jerome-Martin labor market model, FE term structure models, right? Again, the slide rewrites the forward rate using bond prices rather than rates. So F T1 comma T2, which is given by the formula F of T, right? F of T sub 1 comma T sub 2 equals open bracket of P of T sub 1 divided by P of T sub 2 close bracket raised to the power 1 over T sub 2 minus T sub 1 minus 1. Again, PT1 and PT2 and T2 are the prices today of $1 paid at T1 and T2. The longer bond costs less, the longer the bond costs less, the ratio exceeds 1. The ratio is the growth required between 2 days. The ratio annualizes and minus 1 strips the principal. This version is preferred on a trading desk because discount factor comes straight out of the curve bill, no rate conversion immediate, right? Then we have looked at the continuous compounding also. This is the formula. And again, F of T sub 1 comma T sub 2 equals open bracket the natural log of P of T sub 1 minus the natural log of P of T sub 2 close bracket divided by T sub 2 minus T sub 1. Under continuous compounding, the product of growth factor becomes the sum of logs. The forward rate is then the difference of two logs spread over the length of the period. Division and roots are replaced by subtraction and division. Then we have this one. F of T sub 1 comma T sub 2 equals minus the partial derivative with respect to T for the natural log of P of T. The new symbol which you are showing, the partial derivative sign, measures the rate of change of the function with respect to one variable while the others are fixed. The third line which is given, right, is not actually equal to the second, right? The partial derivative is the limiting case of T1, T2 is moved down from T1. It defines the instantaneous forward rate Ft at a single point, not the average rate of the interval T1, T2. The correct statement is actually your Ft, partial derivative of ln pt divided by your del t with no T1, T2 on the left side, right? The continuous form is the input from HJM, the labor market model, and FE in terms structure model. Those models evolve forward rate directly, so we need the curve expressed this way. Then we get into next part, slide number 11, instantaneous forward rate. Instantaneous forward rate in continuous time finance. Instantaneous forward rate represents the interest rate applicable over an infinitesimal small future time interval. It is obtained as a limiting case of forward rates when the maturity interval becomes extremely small. Formally, instantaneous forward rate at time t, the maturity t is defined as such and such. Using discount factor so and so, instantaneous forward rate can also be expressed by this equation, where PDT denotes the price at time t of zero coupon bond maturing in time t. Instantaneous forward rates are fundamental in modern term structure modeling and from the backbone of several continuous time interest rate models, including all these things. And this model describes the evolution of the entire yield curve continuous time, right? So slide basically defines the forward rate over a period of vanishing length, right? So if you read the first one, right, it is f of t comma t equals the limit of as delta t equals to 0 of f of t comma t plus delta t. Symbols here, t, small t is today's date, the date on the rate is observed. Your delta t is the small increase in maturity, limit is the limit, the value approaches the quantity beneath it shrinks towards 0. The forward rate on the right covers the window from t to t plus delta t, shrinking that window to nothing leaves the rate that applies to single instant t. Then the second formula which is given is f of t comma t equals minus the partial derivative with respect to t, or the natural log of p of t comma t. The PTT is the price quoted at time t of a bond paying $1 at time t. Two arguments when it is priced and when it pays, right? Log of bond price falls as maturity lengthens. The speed of that fall with sign flipped is the instantaneous forward rate. A steeper fall means a higher rate than maturity. One clarification I'll add here is the limit on the first line is written about t on the first hand side while the left hand side carries it. Both sides should be observed at t, right? So the consistent term should be this should be right. Actually, it should be written this way. I'm just giving the correct mathematical form. So small t should be there, then capital T, then the rest is fine. Two forward rates that are easy to confuse: discrete forward F T1 T2, instantaneous forward F T2, right? So their discrete forward is F T1 comma T2, and your instantaneous forward is F T comma T, right? So when you look at your discrete forward, right, which is the first one, right? Discrete forward covers the period of positive line, tradable as an FRA or a swap period. Next one is instantaneous forward, right, which is covers a single point time, not directly tradable. The one difference that matters here is that discrete forward is an average of instantaneous forward across the interval. The instantaneous forward is the value at one maturity where it is used. Instantaneous forward are the state variables in HGM. The object short range models such as Busting and CR must reproduce at time zero to match today's curve. Then we go to slide number 12, which is interrelation between your spot, forward, and discount curves, mathematical connections in the term structure. In fixed income market, discount factor, spot rate, forward rate, and instantaneous forward rates are mathematically interconnected. Together describe the entire term structure of interest rate. The relationship typically follows the sequence: discount factor lead to spot rate to forward rate to instantaneous forward rate. From discount factor to zero rate, the calculation of PT is the discount factor for given maturity. This is the formula. From zero rate to discount factor, this is the formula. From zero rate to forward rate, this is the formula. These relationships ensure arbitrary consistency across the yield curve, right? So basically, slide is basically setting out the convergent chain and giving three formulas for it, right? The stated sequences: discount factors, then spot rates, then forward rate, then instantaneous forward rate. Each object is built from the one before it. Nothing new enters the chain after discount factor. From discount factor to zero rates, R of t equals 1 over t times the natural log of P of t. R t is the continuous compound zero rate for maturity t. That is slide 3's formula with RT written as a function rather than as a subscript. The two notation mean the same thing. From zero rate to discount factor is given P of t equals exponential raised to the power minus R of t times P. The reverse direction multiply the rate by the number of years, split the sign and exponentiate. From zero rate to forward rate, f of t sub 1 comma t sub 2 equals open bracket R of t sub 2 times t sub 2 minus R of t sub 1 times t sub 1 close bracket divided by t sub 2 minus t sub 1, right? The product R t is the total interest accumulated to date t, subtracting the smaller total from the larger leaves the interest earned between the two dates, dividing by the length of that gap with the rate per year of the gap. One understanding which we need to build here is the formula holds under continuous compounding only. With annual compounding, the ratio and root formula from slide 79 must be used instead. Slide does not state the convention. Where it is used, these three convergences are the internal plumbing of any curve operating in this system. Arbitrage free consistency means the price computed from discount curve equal the price computed from the forward curve, right? Then we have your spot, forward, and instantaneous forward curves. Upward sloping yield curve, spot, forward, instantaneous forward curve, upward sloping yield curve, rate, and everything, right? So again, line chart, the horizontal axis is 13 years running from 0 to 10. The vertical axis is, if you look at vertical axis, the rate in percent running from 0 to about your 5.5, three lines are plotted. The plotted curve in green, the discrete forward curve, and an orange dashed line, and the instantaneous forward curve is in pink, right? The one thing the picture shows is when the spot curve slopes upward, the forward curve lies above it at every maturity, and the instantaneous forward curve lies above the forward curve. The ordering follows from the averaging relation on slide number 12. The spot rate is an average of forwards up to that maturity, and an average can only rise if the new values to be added are above it. The pink line is drawn as a step function holding flat between maturities and jumping at each one. That is a plotting artifact from using a small number of points. The true instantaneous forward curve is smooth. The dip in the orange line around year 7 is not an error. A forward rate still fall well, spot rate still rise as long as the forward stays above the spot, right? So that is what we have to understand. Okay. Next is your discussion about forward curve versus yield curve, interpretation of different interest rate curves, different curves derived from the term structures of different purposes in financial market. Spot curve is the yield curve. The spot curve represents the relationship between spot rate and maturity. It is primarily used for pricing bonds and discounting fixed income cash flows. Discount curve is constructed from discount factor. It directly determines the present value of future payment and widely used in derivative pricing and risk management. Forward curve, the forward curve represents the entire or the market implied expectation of future short-term interest rates to provide insight into how interest rates may evolve over time. The forward curve becomes particularly informative during your monetary policy transition by central banks. Different phases of economic cycle, periods of inverted yield curve indicating possible recessions. So while the swot curve is used for pricing, the forward curve is often used for economic interpretation and forecasting. So the slide interprets three curves that are built from the same data but read for different purposes. Spot curve, yield curve, spot rate plotted against maturity, used to price bonds and discount fixed income cash flow. Discount curve plotted against maturity, each point is the present value of $1 at that time that used directly in derivative pricing of the system because no rate conversion step is needed. Forward curve, forward rate plotted against their start date, read as the market implied path of future short-term rates. The slide lists three conditions in which the forward curve carries the most information: central bank policy turning points, different phases of economic policy, and the inverted curves. The new term here is inverted yield curve, a curve where short maturity rates sit above the long maturity rates. The closing line splits the work, the spot and discount curves are pricing tool, the forward curve is a reading tool. Technical clarification, the three curves carry identical information. Any one of them determines the other two through the conversion of slide 12. Difference is what makes easy to see, not what each contains. Where it is used, this desk quote positions against the forward curve because the rate hedge is bet on forward from the spot. The spot rate that stays flat while forward move still produces profit and loss. Then we have numerical example, computing your forward rates. The forward rates derived from spot rates. Suppose the observed zero rate spot rates are given. Maturity is given, zero rate is given. The inputs are a 1 year zero rate of 3% and 2 year zero rate of 4%. Under annual compounding, the calculations are given here. Forward rate from the year 1 to year 2 is obtained from the no arbitrage condition. F12 is the forward rate from year 1 to year 2, written with subscript instead of bracket. It is the same object as when we used to write F of T1, T2, right? On slide number 7, the left side is 2 years of growth at the 2 year rate, the right side is 1 year at the 1 year rate followed by 1 year at a forward rate. The exponent on the forward term is 1 because the second period is 1 year long. And then we calculate it, right? This is the calculation which is done. The numerator is the total growth over 2 years divided out the first year's total. First year's growth leaves the growth in the second year alone. F12 is comes out. F sub 1 comma 2 equals 5.07%. The final line contradicts. So this is actually 5.01, right? This is coming from here, right? It contradicts it, right? So where it is used, this is the FRA rate for a 1:2 contract, and the rate of floating level 2 year swap project for a second period. Pretty straightforward, guys. Then we go to another example, forward rate from discount factors, computing forward rates from using discount factors. Suppose the market factors again are given, right? And again, same thing, inputs are discount factors of 0.97 in 1 year and 0.9 for 2 year. This is a general discount factor formula from slide 10. With the exponent drop, the exponent is there. It was 1 by T2 minus T1. Here it equals 1, right? So because the gap is 1 year, so it disappears. The ratio of the growth needed between year 1 and year 2, subtracting 1 leaves the rate. And then we calculate it, right? The whole calculation is given. So 0.97 divided by 0.92 is 1.05435. And interpretation line is given. And where it is used, curve builders store discount factor, not rates. This route to the forward rate sketch to convergence and avoids rounding drift. Okay, this is another example. Okay. Then we have forward rate numerical example, calculating the 1 year forward rate starting in year 1. This is a diagrammatic representation, dual axis line chart. The horizontal axis is maturity, right? 0 to 10. The left vertical axis is the spot rate in percent, running roughly 2.0 to 4.6. The right vertical axis is the forward rate in percent, running roughly 2.5 to 5. The green solid line is the spot curve. Read against the left axis, the pink dash line is the forward curve rate against the right axis. The one thing the picture shows, the two curves rise together across maturity. Chart does not show that forward exceeds spot despite the title. The two lines sit on different scales, so their rigid positions cannot be compared. The pink line appears to fall below the green line between years 5 to 9 purely because the right axis stretches differently. A single shade axis I used on slide number 30 is the correct way to display the relationship. Slide heading names a single 1 year forward rate calculation. Chart flows curve across all maturities instead, so keep that in mind. The calculation itself is on slide number 15. Then we have slide number 18, which is forward rates and market expectation, interpreting forward rates in financial market. Forward rates are often interpreted as the market expectation of future short-term interest rates. However, this interpretation holds strictly only under the pure expectation hypothesis. The expectation hypothesis, investors assume to be risk neutral, no term premiums or liquidity effects exist. Forward rate equals the expected future short rates in real financial markets. right? Forward rates typically include additional components beyond expectation. Forward rate components, liquidity premium, compensation for holding long-term security, convexity premium arising from non-linear bond price dynamics, rise risk preference, investor demand, compensation for interest rate uncertainty. The forward rate should be viewed as market implied rates incorporating expectation and the risk premium rather than pure forecast, right? The right separates what a forward rate is from what it is often assumed to be pure expectation hypothesis. The theory that forward rate equals the market expected future short rate requires three conditions, all listed on the slide. Investors are risk neutral, no term premium exists, and no liquidity effect exists. New term risk neutral investor requires no extra money for taking uncertainty, term premium, the extra return demanded for holding a longer dated bond. Liquidity premium, compensation for holding a security that is harder to sell. Convexity premium, an adjustment arising because bond prices respond to rate moves in a curve, not straight line way. The slide then lists three components that sit inside the real forward rate beyond expectation, liquidity premium, convexity premium, and risk preferences. The closing line states the working position, a forward rate is a market implied rate, it is not a forecast. One technical clarification here is the three components do not all push in the same direction. Liquidity premium and risk preferences raise forward rate above expected short rates. The convexity premium works the other way and pulls long dated forward rates below expected short rates. In long maturity, the convexity effects can dominate, which is why very long forward curves often slope down. Two rates that are easy to confuse. Forward rate logged in today by trading, observable from the curve. Expected future short rate, a belief of the future, not observable. The one difference that matters is forward rate is a price and can be traded at all. The expected short rate cannot. Where it is used, carry and roll down strategies are built on this kind of gap. A trader who believes forward overstate expected rate to see if it's and earns a premium if rate will not rise as far as the forward supply. Slide number 19 is about uh, uh, you know your discount factor versus spot rates, the key differences, features, spot rates, discount factors. The comparison table, one directional statement, new notation which is given is DF 0, T, the discount factor from today time 0 at time T, and the PT used earlier in the deck. The table lines up five features, spot rate, when we talk about ST. The rate quoted in percent per year determines how discounting is done. It rises when the market demands more return. Discount factor DF 0, T. Price quoted at number below 1 perform the discounting directly and falls when the market demands more return, right? The one difference that matters is that two moves in kind of opposite direction. A higher rate always means a low discount factor with the same maturity. The table also gives the two conversion formula, right? Which is nothing but df of 0, T equals 1 divided by open bracket 1 plus s sub t close bracket raised to the power t. df 0, T exponential minus st raised to power t, right? df of 0, T equals exponential raised to power minus s sub t times t. The first line is annual compounding, the second line is continuous compounding. Both convert one rate into one piece. S sub t up implies your df of 0, comma t down implies p down, right? So the implication sign leaders implies to or leads to, right? The change on left to right arises with spot rate, kind of cut the discount factor, small discount factor, cut the present value of any cash flow at that date. One point which I want to add here in table's rate column is kind of misaligned in the rendering. The annual compounding row shows the dash and the spot rate, and ST appears one row lower under continuous compounding rate. Both rows use the same spot rate ST, only the discount factor formula changes between them. Okay, so remember that. And where it is used, this chain is a sign convention behind DV01 duration. A long bond position loses value when rates rise in the slide kind of states the mechanism in one line. And then we get into next part, slide number 20, which DF decays drives your present value. Again, a dual axis line chart. The horizontal axis is maturity near 0 to 10. Left vertical axis is discount factor running 0.65 to 1, carrying the blue solid line. Right vertical axis is spot rate in percent running 2.0 to 4.5, carrying the orange dot dash line. The one thing the picture shows is that maturity lengthens. The spot rate rises and the discount factor falls. The blue line starts near 1 at short maturity and reaches about 0.63 at 10 years. $1 received in 10 years was 63 cents today at these rates. Technical clarification I'll add here is the point where the two lines cross carries no meaning. The lines are measured in different units on different axes, so the intersection is just an accident of scaling, right? So don't bother about that. Okay. With that, we go to slide number 21, where the practice problem 1, zero rate from bond price. Right, a 3-year zero coupon bond has price, P3 given 0.8638, assuming continuous compounding, the relationship price and zero rate is given by this equation. Taking log, we get this, substitute the value, we get the answer. The continuous compounded 3-year zero rate is approximately 4.87%. So that's perfectly fine. Then we have practice problem number 2, computing discount factor given R, T, using annual compounding PT. The formula is given, you solve it, the present value of $1 received after 5 years is calculated with this, right? So that is also solved, which is 0.7835, right? Then practice problem number 3, forward rate, annual compounding. Suppose the spot rates are given, R1 and R3 are given. We compute the forward rate from year 1 to 3, which is given by this equation. We solve it, we get it. The 2-year implied forward rate is starting year 1, approximately 6.06. You can go back and solve this question, guys, on your own, right? The solutions and practice problems are for you to practice, right? Question number 4, forward rate between year 2 and year 5. Discount factors are given. Calculation is given for forward rate. Substituting the values, we get the 3-year forward rate starting year 2 is approximately 6.5%, right? That's also calculated. Okay, so that's what it is, right? So uh, do it precisely, right? That's the point. And then we have next one, practice problem number 5, instantaneous forward rate. The forward rate for discount, suppose the discount function is given by this equation, instantaneous forward rate is given by this. Compute the logarithm, differentiate, find out the instantaneous forward rate increases linearly with maturity, right? So this is a very interesting question because here the instantaneous forward curve is a straight line and the equation is solved, right? Then we have problem number 6, which is a forward rate under continuous compounding. Forward rate using continuous compounding. Suppose the continuous compounded zero rates are given this. The forward rate is also given, substitute the values and the implied to a forward rate starting in year 1 is given by 6%, right? So that's also solved. Okay. Overall, go back and solve these 6 practice questions. These are for you. That's how the active learning helps. Solutions are given, explanation is given, questions are given. Go back and practice on your own, guys. Overall, the summary discount factors are the raw market data. Every other object in the deck is derived from them by a fixed conversion. Zero rates imported in the same quantity and they convert to and from discount factors by logarithm or by root, depending on the compounding convention. Forward rates are not new information, no arbitrage versus the amount of any two spot rate, either as a ratio raised to a root under annual compounding or as a weighted difference under continuous compounding. When you are shrinking it, right? Shrinking the forward rate to a point gives the instantaneous forward rate, which is negative slope of the log discount curve, and the state variable in continuous term structure models. Spot curve prices, the forward curve informs, and the gap between forward rate and the expected short. If short rate is the term premium that carries strategies target, right? A few common mistakes, mixing the compounding convention, applying the continuous formula, but kind of mixing it. That's a very common problem which happens. Rounding intermediate values, that's also a problem. Don't do that. Forgetting to annualize, that's also a problem. Treating forward rates as forecast. The forward rate is a tradable price containing a liquidity, convexity, and risk premium. Is only equal to an expected future short rate under the pure expectation hypothesis, which kind of does not hold in the practice. And confusing the zero curve with the forward curve. Please understand when the zero curve rises, the forward curve rises faster. It sits above it. That's what you need to remember always, right? That's it, guys. That's it for this lecture. That's it for this lesson. Go back, revise it at least twice. Once you're done it, you will totally fine. Practice questions are there, solutions are there, explanations are there. Lesson has been explained. So just look at the formula, solve it on your own. You will be totally fine. Okay. That's it, guys. That's it from my side. I'll see you in the next lecture. Thank you.